we offer a monthly webinar series. This month, our session is with Hannah Actor. She's manager compliance and training at Ascendium Education Solutions. A little bit more about her on an upcoming slide, but she is definitely one to be able to share what we need to know about PSLF today. So I'm going to thank you, Hannah, for joining. So just a little bit about our organization. So you can find us on the web at DebtSmarts, plural.org. We are a nonprofit statewide organization. We have a mission to help Wisconsinites minimize student loan debt and especially focus on their unmanageable debt. We offer webinars like the one today. We offer information and resources for students before, during, and after college. We have a free newsletter that you can sign up for through our website that offers news and tips. And if you're paying attention at all to things in the news, you'll know that student loan debt is in the news with lots of changes. So we do try to cover those. And then we also host a free confidential caller helpline and email helpline for your student loan questions. So that is, again, that's free. Information is on this slide, so you can reach the helpline by calling 833-589-0750. And if doing email is easier, we've got that set up too. So you can reach us at studentloanquestions@debtsmarts.org. And we're available these ways every workday. Okay. Today's presenter, so we've got Hannah Actor. She's got more than 20 years of experience in learning and development, team management, student loan industry training. She's a certified financial education instructor. Her day job, she works at Ascendium. She oversees internal and external training programs. She co-chairs the Corporate Compliance Committee. So Hannah runs through these kinds of sessions day in, day out. She's counseled thousands of student loan borrowers. She's incredibly accessible. We do invite folks on this call and afterwards to shoot us your questions about PSLF or student loan debt questions in general. So I am going to hand this over.
Great. I'll start sharing my screen.
All right.
Let's see. Okay, I think we're good to get started. Well, thanks everybody for joining. Like Carol said, I will take questions throughout the presentation. So you could put them in the chat and then we'll just break periodically throughout the presentation to take questions. So ask them as you have them. One thing, I'm just going to move something that's in my way here. Okay, got it. So just getting started. Over the past couple of decades, as I'm sure you all know, there's been widespread concern about the increased burden that student loan debt has created for borrowers. For many, it's become an obstacle in the way of having financial security, like being able to achieve basic goals, buying a house, saving for retirement. And last year, the Biden administration announced a one-time student loan debt relief program to help working borrowers relieve some of that burden with the potential of having $10,000 to $20,000 forgiven. However, I'm sure you're all aware, the Supreme Court upheld a challenge to this proposal, preventing it from moving forward. And since then, the Department of Education has said it's considering alternate ways to provide debt relief. But it's still unclear what those ways may be and what forgiveness may come out of that. The good news is there's still an existing program that can provide relief to eligible borrowers through public service loan forgiveness. Recent changes that we're going to share in the session today have made it even easier for borrowers to take advantage. So we'll look at those. Our agenda for today's webinar is going to begin with an overview of the program. And I'm going to call it PSLF most of the time since public service loan forgiveness is a mouthful. There are multiple requirements that must be met in order to receive loan forgiveness. And we're going to go through each one, and we'll also cover the application process. We'll discuss some recent improvements made to the program, including recent changes that create opportunities for borrowers who maybe were not able to qualify before or maybe were being held back. We'll talk about some changes that are going to make this easier. We'll also explore some case studies so you can see examples of how this works for people and you can maybe apply it to yourself. And we'll wrap up with some key details to remember. You may not know whether or not to apply based on your current or potential career, so we'll look at case studies for that too to see if you can assess if PSLF is a good fit. We welcome questions. As I said before, we're going to stop periodically throughout the presentation to answer questions. So as we look at many of the fine details of this program, it may help to know how it originated and what the intent was behind it. It was created under the College Cost Reduction Act of 2007 to provide loan forgiveness to those who make a substantial career commitment to public service. Prior to the implementation of this program, there were concerns about a shortage of workers for key positions in the public sector, which today those concerns seem prophetic because we're in a very tight labor market, and that is the reality now. It is hard to find people for positions in any sector. So some of the most qualified people, they were burdened by student loan debt even back in 2007, and they could end up seeking jobs in the private sector where salaries are typically higher. PSLF was designed to address this problem and help the public sector stay competitive and recruit and retain top talent. So let's look at the actual definition. So as you can see on the screen, the Public Service Loan Forgiveness Program forgives the remaining balance on direct loans after 120 qualifying monthly payments have been made under a qualifying repayment plan while working full-time for a qualifying employer. So not only is public service loan forgiveness a mouthful, so is the definition. And while that one sentence sums up the program and how to qualify, it really doesn't go into the details you need to know. There's a lot happening in this one sentence. So we'll break it down for you further so you can understand each component to the definition. The first component is having an eligible loan. Any federal direct loan qualifies. But there's some confusion here because there are loans made under other federal student loan programs that do not qualify. Loans from the Federal Family Education Loan Program, known as FELP, and the Federal Perkins Loan Program don't qualify on their own. But those loans can become eligible if a person consolidates them into a direct consolidation loan. And this can be done on the website studentaid.gov, and you don't have to worry about writing that down. You're going to hear me mention it like, I don't even know how many times, several times. And also we're going to have it up on slides later in the presentation. Student loans from private lenders do not qualify for PSLF, and private loans cannot be consolidated into a direct student loan. So learn what options are available for a person's private loans. They need to consult the lender who holds the loan. I really can't speak to those because they vary from lender to lender. And it used to be if a person consolidates their federal loans, only qualifying payments that they make on the new direct consolidation loan would count towards the 120 payments required for PSLF. Any payments they made prior to that would not count, so consolidation was like starting all over. There are some waivers currently that allow borrowers with loans and other federal programs that do not normally qualify for PSLF, such as FELP, like I mentioned earlier, and Perkins, to consolidate and still have the past payments they made prior to the consolidation count towards the 120 required payments. And this is a good thing, and we're going to continue to talk about it as we move forward in the presentation. There's also a permanent change being implemented that will make qualifying payments made on direct loans prior to consolidation still count. So really going forward, consolidation will not mean starting over for most borrowers. Now, payments to be considered qualifying payments must be made after October 1st, 2007. And that's back when they originated the program. So that's why payments only from that date on count. And they must be for the full amount due as shown in the bill while working, while being employed full-time for a qualifying employer. So payments you made prior to being employed with a qualifying employer would not count. And normally the payments must meet all these criteria. However, they're working on implementing a number of changes right now that really open up what counts as a qualifying payment. And we're going to discuss all of those as we proceed through the session. One of the changes that's already being factored in is that payments no longer need to be considered all on time, which is you can see why I have it crossed off on the screen. A monthly payment will count no matter when it was made in relation to the due date. They're also going to count partial payments once they add up to a full monthly payment, which was not being done in the past. And one of the first things the definition mentioned is this program requires 120 monthly payments before the remaining balance can be forgiven. So that's at least 10 years. This isn't a quick, easy way to wipe out all of one's student loan debt. It's going to take time and effort. But remember, the intention of the program was to recruit and retain people in the public sector. So they want to make sure borrowers stay working for eligible employers for at least 10 years. Student loan borrowers also likely won't see all of the debt they have today forgiven, as it's what's remaining after 10 years of payments. The payments do not have to be consecutive. So if a person takes a break in between making payments, that could make it go beyond the 10 years. I know it sure would be nice if it forgave everything now, but in the long run, a person's still going to end up paying less than they initially signed up for. And not every repayment plan available counts towards PSLF, and this has been really a common point of confusion for this program. A repayment plan is what determines the monthly payment amount and how long a person has to pay back their student loan. It's important to make sure that you're on the correct repayment plan so your monthly payments count. If not, it could take a person longer than 10 years to reach forgiveness because they'll be making up for the monthly payments they sent in that didn't count towards the program. Right now, there's a temporary opportunity to have payments made under other repayment plans still count, but that's temporary. And again, we're going to talk about that as we move forward. Originally, the way this program was written, a person could only send in one monthly payment at a time, and they were not allowed to pay ahead. If they paid ahead, it just didn't count. Now, with recent changes, they can pay ahead for up to a year at a time with lump sum payments. So if somebody just has an extra, $1,000 or $2,000 they get in a bonus or something, they can send that and have it applied towards this program. They cannot pay ahead more than a year, though, because each year they're required to renew the repayment plan they're on. And during this process, it could change the monthly payment. And therefore, the student loan servicer wouldn't know what the monthly payment is going to be next year to apply any lump sum payments beyond that year. So you can pay ahead, but only up to a year at a time. Lastly, as you're all likely aware, all direct loans were in a payment suspension because of the COVID-19 pandemic, and that started in March of 2020, and that meant no payments were due for any borrowers with direct loans during that time. The suspension ended in September. The months spent in this payment suspension from March of 2020 until April of 2023, August, different A month, August of 2023, do count as qualifying payments. So that payment suspension is not going to delay borrowers in reaching forgiveness at the end. And actually, it's a great thing because people got, I want to say 39 monthly payments or maybe even 40 without actually having to make a payment. So it advanced a lot of people's payment count without them having to pay. Now, it's possible some borrowers may be in a program where they're having payments made by one of the organizations on the screen towards their loan. Those payments can count even if they weren't paid by the borrower themselves, and they are typically sent in as one-time lump sum payments. Now, if they don't stay with the organization listed in the slide for the full 10 years, which is often the case in these organizations, they need to make sure their next employer still falls under the public service umbrella until they get to year 10 and officially qualify to have the remaining balance forgiven. So this is the big component to the definition that I kind of alluded to earlier. Borrowers need to be on a qualifying repayment plan. And many borrowers were not aware this was part of the requirement. And this is why we did see so many, high rejection rates in the beginning of this plan. So on the screen are the repayment plans that do count towards the 120 qualifying payments required for PSLF. The first one listed is the standard plan. And this is the plan borrowers are automatically placed on when they leave school. Notice it says it's a 10-year repayment plan. Borrowers cannot stay on the standard plan the entire 10 years they're seeking forgiveness because they'd end up paying the loan back on their own before they fully qualify. You might be wondering, why did they keep this in here? Well, they include this plan so the monthly payments student loan borrowers may have already made when they first left school still count towards the 120 payment requirement. Once a person has landed on PSLF being right for them, they need to switch from the standard plan or whatever plan they're on to one of the income-driven repayment plans, also called IDR. The current individual IDR plans are listed on the screen, along with the newest one called Saving on a Valuable Education, or SAVE. One item of note is that Repay is no longer available. Again, that's why I have it crossed off. Borrowers on repay were shifted to save last fall. Payments made under the repay plan in the past do still count towards the 120 payment requirement though. And I'm going to go over the similarities amongst all the current IDR plans on the next screen. If you want to learn more specifically about SAVE, or honestly any of them, studentaid.gov continues to be the place to go. So here are the similarities amongst the current IDR plans. And income-driven repayment plans, they're just that. One's income is a significant factor in driving their monthly payment. And the idea behind these plans is they take income and family size into consideration to determine a monthly payment that's more affordable for the borrower. And as you can see, payments are currently capped at 10 to 15% of discretionary income, and that's for the majority of the IDR plans. But once implemented this summer, the SAVE plan could have some borrowers seeing their payments capped at 5% of discretionary income. So it's going to go even lower. And if you're wondering how they calculate discretionary income, I'll be referring you to some helpful tools a bit later in our presentation. So you could go in and kind of calculate how it works for specific situations. But they're really just focusing on the difference of one's income and a certain percentage of the poverty level for their family size. And under these repayment plans, it's possible to get a monthly payment of $0. To me, that's always weird to say that's a monthly payment, but you could get a monthly payment that is $0, and that's still considered to be a qualifying payment, both for PSLF and IDR. And as you can imagine, with payments that low, it is going to be impossible for some people to ever repay their balance. This is why all the IDR plans currently have a maximum repayment period. And it used to be 20 or 25 years, depending on the plan. And then the remaining balance was forgiven at that time. And this is aside from PSLF, because that's a 10-year program. But for IDR, for people who aren't working towards PSLF, it used to be after 20 or 25 years, they'd have the remaining balance forgiven. For the SAVE plan, forgiveness can come as soon as 10 years for borrowers. And the criteria for that is they have to have an original principal balance of $12,000 or less. And then they add an extra year for every $1,000 over that $12,000 mark. And then they cap it at year 20 for most borrowers. And then borrowers who took out some loans for grad school, they'll cap it at year 25. However, again, if you have student loans exceeding $12,000 and you're pursuing PSLF, you don't have to worry about year 20 or 25. PSLF's a 10-year program. So let's go back to the earlier definition and think about that. We've covered eligible loans. We've covered what's considered qualifying monthly payments. We've covered what's considered a qualifying repayment plan. The other thing we have to look at is that they have to work full-time. So one is generally considered to work full-time if they work a minimum of 30 hours per week on average. And just this last year, they expanded the definition because it was still unclear for certain careers. So now it includes employment periods that are more typical in an educational setting, like working at least 30 hours per week for at least 8 months out of the year, or they have a formula for determining 30 hours per week by multiplying credit or contract hours. And if borrowers are employed in more than one qualifying part-time job at the same time, they'll be considered full-time if they work a combined average of at least 30 hours per week amongst all their employers. And another recent change is that they're going to count, a month will count as long as the borrower met the definition of qualifying employment at some point in the month. It doesn't necessarily have to be for the full month. So this is kind of a scenario where if you start a job, say on the 20th of the month, that month could potentially count where you don't have to worry about waiting until the 1st of the next month. And not only do borrowers need to work full-time, but this is kind of the meat and potatoes of the whole thing. They need to work for a qualifying employer, as was intended back when they created the program. Qualifying employment for the PSLF program is not about one's occupation or the specific job that they do for their employer. Rather, it's about who the employer is. And the good news is many employers qualify. In fact, it's estimated today that 1 in 4 Americans work for a qualifying employer. So this covers a lot of people. The first few employers listed are pretty cut and dry when it comes to whether or not they qualify. If the employer is the government, at any level, the borrower can qualify. They're definitely working for a public service employer. if the employer is tax exempt under the IRS code, like many nonprofit and not-for-profit organizations are, then they can qualify for PSLF, as these organizations are meant to benefit the public, and that meets the aspect of public service this program's looking for. And if they serve an AmeriCorps or Peace Corps, they can qualify too, because those are also considered public service positions. So qualifying employers also include private not-for-profit organizations that provide at least one of the following public services. The difference here is, notice it doesn't say they have to be tax exempt. Where before nonprofits had to be tax exempt and coded as a 501c3, now some nonprofits can still be included in this even if they're not tax exempt, as long as the organization offers one of these services. And I won't read the list to you on the screen, it's there for you to see. Also, it's on the application itself, but it's a long list. So I have 2 slides covering it. So here's the first one, and here's the next one. So again, it's not about the job the person does for the employer, it's about what the employer does. So as long as the employer offers one of these services, it is nonprofit, they should be good to go. They also recently opened it up to include positions involving religious instruction or preaching, which were previously excluded. So now that we've discussed the qualifications, I have a scenario to help you just brainstorm how this program works. You don't have to answer it out loud or anything like that, but just kind of think about it and then I'll give you the answer. Violet is a pharmacist, and she works full-time in the pharmacy department of a large for-profit retail store. Does she meet the eligibility requirements for PSLF? This gives me a chance to take a drink of water while you're thinking about it, and then I will give you the answer here in a moment. Okay, the answer is no. That's the short answer. The long answer, it really comes down to whether or not her employer meets the qualifications. So public health was listed on one of the previous slides, but it comes down to who she works for, not necessarily what she does. And in this case, Violet's employer isn't eligible because they're for profit. She could find a job working for a qualifying employer, because there certainly are pharmacies that are probably run by a qualifying employer. For instance, the VA comes to mind. They're government funded. A pharmacist working for the VA is likely going to qualify. But if she does that, she may have to take pay cuts. And this is where she needs to decide, is it worth finding an eligible employer if her salary may be different? They are looking at opening up PSLF to some qualifying public service professions rather than just looking at the employer, but that's a future target and it hasn't become official at this point. So we've spent a fair amount of time on which employers do qualify. And just so you know, here's another, after this slide, I'll probably pause to see if there's any questions out there. So if you have questions, maybe get them in the chat. But I like to switch gears and just talk about non-qualifying employers in case somebody feels like their employer falls in a gray area. On the screen, you can see labor unions do not qualify. And this is not about being a member of a union, but rather if the union is the actual employer. Employment through partisan political organizations also would not count. And as we mentioned with the scenario in Violet, any for-profit organizations also do not count, as they're not considered to be a public service. This means employers who are contracted to do work on behalf of the government still will not qualify if they're for-profit. And it's worth adding, contractors just normally do not qualify in general because they're contracted and not working for the organization that's hired them. There is a new exception that's existing for borrowers, and this is with contractors. It exists for borrowers who work in a state that has laws preventing direct hiring for an eligible employer. In that case, contract employment may work, but the main population this is applied to so far is not in Wisconsin. It's really for like doctors in the states of California and Texas because of some hiring freezes they've had. So like I mentioned at the end of this slide, I thought we'd pause, see if there's questions out there. If not, we'll move forward. I don't see any in the chat. I don't know if anybody has any they want to, I think we're a small group, so you can just voice your question, put it in the chat. If not, we'll move on.
Hannah, not so much a question, or though maybe it is. I think there's a listing, like you can actually look up your organization on student. Is that right? If you're like, I'm not sure if this is a qualifying employer.
Correct. So the PSLF help tool, which is going to come up here in a few slides, they have a place where somebody can enter in their employer's EIN, the employer identification number, and then it'll just pop up your employer qualifies or they don't. It isn't a perfect tool. I don't think it recognizes every single employer, but it does recognize a lot of them. And I mean, it's going off of, tax codes or EIN numbers. So most of the time you're going to get an accurate answer there. If somebody's still confident their employer qualifies, I always say just move forward with the application process because it's possible they're missing it.
Thank
So
you.
good question. And I don't see any others. So I'm just going to move forward. But again, get your questions out there. I'll stop again to see if any questions have been added. So it kind of goes to the application process. We've covered enough about the program, and chances are you maybe knew that you wanted to apply before you even joined the webinar today. So let's look at the application process and what those steps are. If you are somebody who has been working towards PSLF for a while now, you may know that a few years ago there were multiple forms for this process, which added more confusion. The good news is now there's one form and they've made the process simpler. And I know I've already mentioned it, but studentaid.gov, it's a great resource. The Department of Education has created this for all things student loan related. It's a one-stop shop. It's the website a person can first go to track down all of their federal student loans in case they're worried they lost track of some over time. It's also where a person could go to learn about the various options available, such as the different repayment plans, forgiveness programs, even ways to postpone payment. It has this wonderful loan simulator tool, which a person can go to. They plug in their information, like their income, their family size, and some other factors, and it'll kind of give them estimates of what their monthly payment would be under each repayment plan so they can find the best one for them. Again, for PSLF, you need to look at the IDR plans. And you can apply for an IDR plan from this website too, but I will say do your application separately. There's a link on the PSLF application that could take you to the IDR application, but I don't recommend that. Jumping from one application to the next may cause the first one to time out, and that would force you to have to start all over. So it's best to do one application at a time, save yourself some heartache. For the PSLF application, it's estimated to take about 30 minutes, and that is in the PSLF help tool I had mentioned just a bit ago. So set aside some time to complete all of it at once. And there are some things you'll need to do to get yourself prepared, especially since the website makes you start over if you don't complete it in one sitting. You'll need your FSA ID, and if you don't know it, you can create one right at studentaid.gov. You'll also need your employer's federal identification number that I just mentioned earlier. And if you don't know it, either do I, but you can find it on your W-2, or you can simply contact your employer, payroll, HR, they can find you the EIN. So the PSLF help tool, what is this? So once you go to studentaid.gov, they have a section just for the PSLF help tool, and it was designed to make the process easier. It explains the program in more detail, allows borrowers to enter in who their employer is to see if they qualify, tells them if their loans do or do not qualify, and gives them information on next steps. Since you log in right at studentaid.gov, it can pull up your loans and see them, so you don't have to enter it in and hope you're entering it in correctly. It can see them and say, oh, you have a direct loan, you're good to go. Oh, you have a FFEL loan, you need to consolidate first. So it tells you what to do. And the application can be done straight from here too. A new feature is that it now allows for digital signature and submission, eliminating the need to print, which again was another pain point for people. And one student loan servicer handles public service loan forgiveness, and this ensures consistency in handling the program. So unless the borrower is already with the PSLF servicer, they can expect their loan to be transferred to the new PSLF servicer after their application gets processed. And the PSLF servicer used to be Fed Loan Servicing. However, Fed Loan announced they were no longer servicing student loans back in 2022. Mohila took over as the new PSLF servicer after that. And borrowers who were already working towards PSLF when this transition happened, they saw their loans move from Fed Loans to Mohila. Borrowers who are just now applying will see their loans transfer to Mohila once their application is processed. Unless they were already with Mohila, then they'll just stay there. MOHELA is the one in charge of determining how many qualifying payments have been made and keeping track of them over time. And they provide information to borrowers on their progress, so they can give an updated payment count every time an application is submitted. And for that reason, we recommend submitting the application on an annual basis. A lot of people waited to year 10, and that can be problematic because proving 10 years of employment retroactively can just be cumbersome. But also, if something went wrong, if a person was on the wrong repayment plan, they don't want to spot that at year 10 and have to start over. It's much easier to spot that, a year at a time. So you submit the application, you see it's been processed, and then you go and look to see if your payment count has advanced. If it has, everything's going as it should. And then obviously, if you switch employers, you're going to want to, apply again anytime you switch employers. So we've covered the standard program requirements. And as I previously mentioned, PSLF began back in 2007, and people didn't become eligible until 2017 then. And if you went back to 2017 and you started to read about this program, you're going to find that there was extremely high rejection rates at that time. Since then, the Department of Education has made a few significant changes to improve the program's effectiveness and to restore the goal of providing relief to public service workers who may be burdened by student loan debt and lower salaries. One of the biggest concerns and criticisms to date was the low number of borrowers who were actually approved for this forgiveness. The majority that were rejected were because they didn't have the right loan or they were not on the right repayment plan. And there was a lot of confusion about the program, particularly in the beginning. There wasn't that awareness that's now there. So many borrowers applied who simply didn't qualify. Others didn't know the steps they needed to take to apply, which caused delays. That's why the PSLF help tool was created, and it was one of the first improvements made back in 2018 to make this process easier, to make borrowers more aware of what they needed to do. Also in 2018, Congress allocated $350 billion to forgive loans of borrowers who would have qualified for PSLF, but were in the wrong repayment plan. So they kind of owned up to the fact that they really weren't doing a great job of telling borrowers that they needed to be on an income-driven repayment plan. And so what they said with this program, temporary expanded public service loan forgiveness, is that borrowers who got to year 10, applied, and were rejected could apply again, basically saying, I was not aware I needed to be on a different repayment plan, and they'd reconsider them. Forgiveness under TEPSLF is on a first come, first served basis. Once all the funds are used, the opportunity ends. As last I checked, though, there's plenty of funds still there. And borrowers can apply just using the standard application. Again, though, this is for borrowers who got to year 10, already applied, and were rejected because they were on the wrong repayment plan. The idea is try again. TEPSLF was intended for borrowers who were rejected in the first few years of the program. More recently, the Department of Education has implemented a new reconsideration process for borrowers who feel their application wasn't processed correctly, and this does happen. This reconsideration request is only for specific situations where borrowers are told their employer does not qualify, but they believe the employer does meet the qualifications. In this case, they can provide additional information to show that their employer is indeed eligible. For instance, they could submit a W-2 or something else to verify the EIN. So again, sometimes the database isn't as robust as it should be, and an employer isn't recognized. A borrower may just need to do a little more work to prove they work for a qualifying employer. Borrowers can also submit a reconsideration request if they think the payment count was updated incorrectly after receiving a letter from MOHELA stating what the new payment count is. The reconsideration process is not intended to replace the application process, though. People shouldn't just keep using this to get their payment count updated. It really is just for situations where the application may not have been processed correctly. And this is a big one that's happening now. So there was previously a highly publicized waiver specific to PSLF that expired on October 31st of 2022. However, other account adjustments are happening behind the scenes still today that may not be as well known. And the idea is to help borrowers experience the same benefits as what the waiver previously did. For example, this is this one-time payment count adjustment. and it could advance borrowers' payment count towards the 120 payments required for forgiveness. The department is completing account reviews for this, and they're already doing it, and it's expected to continue happening until this summer. They're making adjustments for any months spent in a repayment status, regardless of the payments made, of the loan type, of the repayment plan. So basically, any months the borrower was in repayment, even if they weren't making payments, they're going to count. This account adjustment is being made automatically, so borrowers with direct or ed-held loans, they don't need to do anything to make it happen. They have no additional steps they need to take. They're just going to get informed that it happened and what the resulting payment count was. The department has also said they'll consider the payment history for borrowers in other loan programs that don't qualify for PSLF, as long as they consolidate into the direct loan program. So what that means is borrowers with FFEL, Perkins, or HEAL loans, they do need to consolidate to participate in this. They're the only group of borrowers that do need to take additional steps to get this account adjustment to happen for them. So they need to consolidate, and they need to do that by the end of this next April. That'll give the department enough time to process the consolidation application before they finish doing these one-time adjustments this summer. So kind of just to recap that, borrowers in the direct loan program or who have ed-held loans already, they need not do anything, and they're just going to have their payment count adjusted, both for IDR and for PSLF. Borrowers in FFEL, Perkins, or HEAL need to consolidate, and they need to do so quickly. Again, that could be done at studentaid.gov. Account adjustments will also be made for periods of deferment and forbearance in these payment calculations and then applied towards PSLF. Department officials assert that years of what they call forbearance steering led to borrowers with loans placed in a category that was detrimental to their repayment progress. Therefore, they intend to reverse years of setbacks. The idea is they felt like some borrowers are calling into their student loan servicers saying, I'm struggling to pay, and the servicer would just put them in a forbearance. And then they wouldn't be able to count those months in forbearance towards PSLF or IDR. And so now the department's trying to correct that. So from what we know now, these adjustments will be finished this summer, with the department saying they're targeting July. Adjustments will be automatically applied for borrowers who had 12 months or more of consecutive forbearance time, or 36 months or more of forbearance used throughout the life of their loan. For borrowers who use shorter periods of forbearance, their accounts will not be automatically triggered for an adjustment. And in these situations, the department has said borrowers can request an account review with the Office of Federal Student Aid's Ombudsman at the site on the screen. And periods of deferment prior to 2013 are also going to be factored into these account adjustments, aside from the in-school deferment. And all time spent in the academic hardship deferment, even after 2013, is also going to count. And these adjustments are a one-time thing. So if you've got notification that your adjustment already happened, it's done. They're a one-time thing. Borrowers will not continue to benefit from them once they're completed this summer. However, the department recently implemented permanent changes to how deferments and forbearances are factored into the payment count going forward. Specific periods of deferment and forbearance will count towards the 120 qualifying payment requirement going forward. It doesn't apply to all deferments and forbearances, only the ones listed on this slide. It means that borrowers will not always have to be in a repayment status during the 10 years they're working for a qualifying employer, though. So if they're going into one of these specific deferments or forbearances, that's still going to count. And this is another spot where I'll take a quick break, see if anybody wants to throw a question out there. We can answer questions before we move to the next section. I don't see anything in the chat, but just in case somebody has something they want to throw out there. Okay, we'll move along. So sometimes it helps to see examples. Oh, wait, I think I saw one. Yeah, go ahead.
Sorry, yeah, there is a question in the chat. Do we apply before or after the 120 payments?
Good question. Do it before. I mean, there's no rule saying that you can't wait until after, but it's better to do it before, because if there's any issues, you're going to find out that first time you apply so you can fix them. If you wait until you already made 120 payments and perhaps you're on the wrong repayment plan, it could be too late to fix it. So it's better to apply every year. And then when you get to year 10, that last time you apply, you'll just have everything forgiven. But don't wait. I'd say apply right away. As soon as you know you're working for a qualifying employer and you've made some payments, apply, and then apply each year after.
And then just to follow up on this, so if a borrower doesn't know what kind of loan they have, they can go into studentaid.gov, plug in their information, and it'll show what kind, and they'll know whether they need to consolidate.
Correct.
Okay.
So it's okay if you don't know your loan types. If I hadn't worked for a student loan company when I left school, I wouldn't have had a clue. But if you go to studentaid.gov, you can track down your loans there, and it'll tell you what your loan types are. But if that still doesn't quite make sense to you, when you start using the PSLF help tool and you plug in who you are, it'll figure it out for you and say, you have this type of loan, it qualifies. You have this type of loan, it doesn't, you need to consolidate. It'll tell you what you need to do. Good questions. So sometimes it helps to see examples of how this would work in specific scenarios. Let's look at some case studies. First, we have Sarah. She's single with no dependents. And as you can see, her income is $80,000 a year. Her student loan debt is at $60,000 with an average interest rate. So let's see how public service loan forgiveness would benefit her. And all this assumes that her employer qualifies. Throughout the 10 years she works towards forgiveness, her estimated monthly payments would be between $393 and $697 under one of the income-driven repayment plans. And it's a range because the tool assumes she's going to see an increase in salary over time. But SAVE looks to be the one that's going to cost her the least in the long run. She'll end up paying around $64,000 herself throughout the 10 years. And you may recall her overall loan debt was less than that at $60,000, but with interest, she would have paid a lot more than the $60,000. In the end, she's still estimated to have over $15,000 forgiven under the SAVE plan. And next we have Andre and Tina. They're married with 2 children, and they have a combined income of $75,000 a year. Since they file taxes jointly, their combined income would need to be taken into account for any of the IDR plans. The good news is it will also take their combined student loan debt into consideration too, so the estimated payment could be for both of their loans. In this case, though, in this scenario, the debt is only for Andre, and it's at $35,000. If Tina had student loan debt of her own, she'd also have to have a qualifying employer for both of their debts to be considered for PSLF. They'd also have to apply separately for their respective loans. It's all treated separate. But the one thing is, because they file taxes jointly, both of their incomes do count towards IDR. Again, in this scenario, though, the student loan debt is just for Andre. And for these two, their estimated monthly payment under the SAVE plan will range between $63 and $275. In the end, they'll pay over $19,000 and have over $29,000 forgiven. And the last scenario is Jill. She's a single parent with 2 kids. Her annual income is $45,000 and her total student loan debt is $50,000. And unless Jill's situation greatly changes over the next 10 years, she could benefit quite a bit from PSLF. She's estimated to pay between $0 and $10 a month under the SAVE plan while she's working towards forgiveness. And that's all kind of dependent on her 2 children and how long they remain dependents on her. After 120 qualified payments, she'd have paid around $120 and have $50,000 forgiven. She looks like a great candidate for PSLF. And you may have noticed that I use the SAVE plan with all of these case studies, and that's because the loan simulator tool at studentaid.gov showed the lowest possible monthly payment in each scenario was under the SAVE plan. Borrowers seeking PSLF would want to select the qualifying repayment plan that gives them the lowest payment, so they can see more forgiven in the end. And the loan simulator tool helps them determine which plan gives the lowest payment. It helps them get a side-by-side comparison. Typically, it's going to be SAVE, but not in every situation, just in most. The last case studies demonstrated folks who are already working towards PSLF. Let's look at somebody who's just now starting to explore it to see if it's a good fit. We have Ivan. Ivan graduated with a bachelor's degree in health science. And for the past 3 years, he's been working full-time at the YMCA as a fitness director. He enjoys the job, but he'd eventually like to pursue a career more in his field of study. His annual salary is $45,000, and he has $33,000 in direct loan debt. Currently, he pays $358 on the 10-year standard repayment plan. So the question I want you to kind of brainstorm and think about, you don't have to answer, just sort of think it through. Do you think PSLF would be a good fit for Ivan? While you're thinking about it, I'm gonna take a water break and then I'll let you know my thoughts on it. So the answer on this one is it could. I think it depends a little bit on his situation and what he wants to do, but PSLF could work for him. As far as I know, the YMCA is a qualifying employer. And if he moves to an IDR plan, I did the calculations, studentaid.gov for this, he could see his amount reduced to as low as $102 to $244 a month, depending on the IDR plan he chooses. So definitely a lower monthly payment. He also would see about $29,000 forgiven under the SAVE plan. PSLF could be a great option for him. To make his decision, he may want to look at a few factors, like how much more could he get paid per year if he pursued a different career or a different job? You know, if he had an annual salary giving him $30,000 more a year, well, then that one-time $29,000 forgiveness wouldn't look as good. But another factor might be how happy he is at his current job. Maybe he really likes it there, and this is what he needs to motivate him to stay. And then having that lower monthly payment in his, monthly budget could also really be helpful. So I can't answer this question. It's a personal question for Ivan. There's different factors he wants to look at, but PSLF could work quite well. There have been many articles and reports on public service loan forgiveness over the past few years, and I'm sure you've read some of them. Some speculate on the future of PSLF, and it's certainly possible funding for the program could be cut. It's government funding, but it's also possible it won't be. The speculation on the longevity of the program has been going on since its inception. It's not new. It should not be used as a reason to keep somebody from applying. Also, a lot of people may be concerned about future tax implications, and this should not be a concern with this program. The amounts forgiven at the end cannot be taxed at the federal level. And that has not always been the case with some forgiveness programs, so I could see why people worry about facing a big tax bill at the end. That won't be the case with PSLF. The regulations have been clear. Borrowers cannot face a federal tax. That could be different at the state level. So someone would want to check with a tax expert in their state to see how it impacts them there. I know we're looking at the state of Wisconsin here. I'd still say check with a tax expert to make sure. But at the federal level, it cannot be taxed. Before we start to wrap up, I'm just going to go over a few key points to remember. One needs to be on an income-driven repayment plan. I've mentioned this several times, but I really can't emphasize this enough. This is where so many student loan borrowers went wrong at the start of this program, and it's one of the reasons why they're doing the account adjustments this year. If a person's not on one already, they should just apply for an IDR plan now. And again, this can be done at studentaid.gov. Also, a person must be working, for a qualifying employer at the time they submit the form for forgiveness and at the time the remaining balance is forgiven. I know that seems obvious, but it's been a common reason for rejected applications as people are going back. Maybe now they're working for a for-profit organization and they're trying to apply based on something they did 5 years ago. You have to be currently working for a qualifying employer. Not always the same one, but the current one needs to be qualified. The department has also made changes allowing for certain types of deferments and forbearances to count, but the changes don't apply to all deferments and forbearances. So therefore, a person wants to be cautious when it comes to using deferments and forbearances because that could cause a delay. Here, I just wanted to make sure I included some resources for PSLF and student loans. First is the PSLF help tool that we've referenced throughout the presentation. Next is the Savvy tool, and that's provided by the Wisconsin Department of Financial Institutions, partnered with Savvy and Elevate Wisconsin to help provide student loan relief for Wisconsin employees. It's designed to help make the application process even easier for PSLF, so you could do it here too as well, like one or the other. You could go to the PSLF help tool, or you could do it at Savvy. And you could also do IDR applications here too. I included the PSLF hotline at Mohila. That's to help you connect directly with one of their PSLF specialists. And lastly, I included the same number Carol had in the beginning, our Wisconsin Student Loan Help Hotline. It's an anonymous way to get free student loan advice. It was created in partnership with Wisconsin Coalition on Student Debt and Ascendium Education Solutions. And really, any student loan question is welcome. It doesn't have to be specific to PSLF. So, given this is a 10-year program, I recommend student loan borrowers don't delay. They should just apply right away to get started as long as they have a qualifying employer. And studentaid.gov is a great resource just to go and read anything about student loans, but specific to PSLF, you can read all about the program there. And with that, before we close, I think I'll stay on for a little bit and just see if anybody has any last questions they want to ask.
I will say, while people are thinking about their questions, again, the recording will be shared out with anyone who is registered, along with the slides. Hannah has also created a very helpful handout with some of the resources that she's mentioned. You can call with those questions, that helpline. You can also email that helpline. Our website at the coalition is debtsmarts.org. And we are constantly adding new resources about all aspects of student borrowing and best practices for students and borrowers and future borrowers. And if you have friends or colleagues who couldn't make the time today, please do share our information with them, and we'd be happy to share out these resources. All right, we've got a thanks, great presentation. I agree, Hannah.
Oh, thank you.
Your stuff.
I'm happy to help.
Great.